Glad you could make our time to join us on today's episode of Tax Matters. My name is Olumuyiwa Matuloko, and with me on today's episode is Christina Pius.
Hello, viewers.
Brand new week, brand new episode. Last episode, we had a guest, Mr. A.J. Bamidele, Director of Land Tax Office, Oil and Gas at the Federal Inland Revenue Service. That is in continuation of our series on Petroleum Profit Tax Administration in Nigeria. Towards the end of that first offering of Mr. Bamidele's interview, talking about the episode of last week, we took him up on transfer pricing, a topic on which Mr. Bamidele has become an expert of sorts. Mr. Bamidele told us that the transfer pricing regulations for Nigeria were released on August 2nd, 2012, and that the regulations emerged from the practical manual for developing countries developed by the United Nations. That will be our take-up point today, but that will be later, after we bring you up to speed on some of the events happening in the taxation industry in Nigeria. Once again, welcome to Tax Matters. Christina has the first story.
On Wednesday, 28th of March 2013, Pedabo Associates, a private tax and business advisory consulting firm, organized a breakfast seminar on transfer pricing at the Civic Center in Victoria Island, Lagos. Two major papers were presented. Mr. A.J. Bamidele of the FRS presented a paper on advanced pricing arrangements, FRS perspective, while Mr. Sachin Vasudeva presented a paper on transfer pricing implementation, the Indian experience. Before then, these two gentlemen from the hosting organization set the stage for the stimulating session.
Why are we here? Transfer pricing is why we are here. And for me, I know it became an issue the moment the taxman became interested in transfer pricing. Because as business managers, the intention is to keep as much of the bottom line as possible with for our shareholders and for our expansion. And here, a major silent shareholder comes and says, no, that bottom line you are reporting, I'm interested in how you arrived at it.
Businesses have always done businesses with their affiliates. We have provisions in the existing tax laws that governs related party transaction. We used to refer to it mainly as, or it is still artificial transaction. The Revenue Authority are usually, put on inquiry where they see transaction between connected entities. And of course, we have several provisions in the company's income tax. I think it's Section 22, personal income tax, and the petroleum profit tax. But the difference is that before the introduction of the transfer pricing, adjustments are only to be made based on the, more or less, the determination of the Revenue Authority, the way they see the transaction. If they think that it is not at arm's length, it has not been carried out, based on market transaction or conditions, they make adjustments, okay? And those are what we have. There was no scientific basis for determining transfer prices. And it's a bit very subjective and discretionary. But with the advent of transfer pricing, we believe that has come to make it more scientific, make it more compulsory, and it becomes an issue. Of course, a lot of companies have also asked questions. I'm not a multinational. I'm not, in fact, I don't even have too much of a group. Is it relevant to me? Local companies have not been excluded in the Nigerian transfer pricing regulation, even though a lot of us believe that maybe since we're just starting, we'll have concentrated more on the multinational. But of course, where companies are in a group and one member is probably recurring losses, it is possible to shift losses from one company to the other. And they have decided to include all of those companies in the regulation. Mr. Bamidele is going to be giving us more of the highlights of the Nigerian transfer pricing regulation. He will also dwell more on the advanced pricing arrangements or agreements.
Nothing is bad when we talk of transfer pricing. Is transfer mispricing that is bad. Definitely there is going to be a means of transferring price from one party to another. But when it becomes mispricing, that's when it becomes a concern to the Revenue Authority.
And documentation of the data is the most important aspect in a transfer pricing analysis.
For more on transfer pricing, stay tuned for the continuation of our interview with Mr. AJ Bamidele. We move on to the next story, and like we said, it's all part of a whole. We're still talking oil and gas taxation. From time to time, stakeholders in the oil and gas sector come together to share ideas, to brainstorm, and to chart the way for the future. And the goal is one single goal: to improve revenue accruing into government coffers from that sector. Again, Christina has the story.
Between Tuesday the 19th and Friday the 22nd of March 2013, gentlemen and ladies from 5 government agencies gathered together for the 2013 edition of the Interagency Retreat under the auspices of the Monitoring Committee for Accelerated Revenue Generation and Enhancement of Petroleum Profit Tax and Royalty. Theme for the 2013 edition was Revenue Generation and Enhancement, Issues, Challenges and Prospects. Again, Mr. AJ Bamidele was on hand to welcome participants, while Mr. G. Jedi Agba of the NNPC delivered the keynote address. The acting executive chairman of the FIRS, Alhaji Kabiru Mashi, was represented at the event by Mr. S.S. Ogungbeso.
As we all know, the oil and gas sector is the mainstay of our nation's economy, and this will probably remain so for some time to come. It's also recognized that the product crude oil gas, this important sector, is unfortunately a wasting asset that will surely be exhausted one day. It is therefore reasonable to take every necessary step to optimize revenue from this sector and invest the proceeds wisely. One of the steps that will be taken by federal government is the setting up of this monitoring committee, the objective of which, as the name suggests, is to enhance revenue generation for petroleum profit tax and royalty through interagency cooperation. It is gladdening to know that the monitoring committee has not only remained relevant since its creation, but has also continued to set the pace in interagency cooperation in the interest of our dear nation. You will not be evaluated or measured at the end of the day on the number of meetings you hold. It is the resolution of problems, and this must be felt by all the agencies.
In the course of the 3 days, several papers were presented and discussed. At the end, a communique was issued.
The Interagency Monitoring Committee, which consists of 5 government agencies, convened to critically examine issues and challenges bordering on revenue generation and remittances, to provide solutions to optimize government revenue. At the end of the presentations and general discussions, a communique was issued as follows. 1. Develop common template for reporting revenue and other related data by all relevant agencies to ensure uniformity. 4. The interagency to urgently convene the annual reconciliation meeting to validate production, liftings, proceeds and remittances. This is to be facilitated by NAPIMS and COMD. 8. Interagency should develop modalities for implementing the petroleum industry bill when passed into law to ensure early delivery of values to the Federation.
You also spoke to representatives of the participating organizations.
Yes, we wanted to know why the retreat was necessary in the first place, the objectives and the achievements.
The major consideration is to boost government revenue. And when government revenue receives a boost, the people also receive a boost in terms of the benefits from those revenues.
We need to speak as one, as government interagencies. Okay. The moment we start to speak as one, the better for government, the better for the resort, the better for the data we are showing out to the public.
With the combined efforts, as has been happening, we'll see that revenue generation is enhanced and is increasing year in, year out.
After the retreat, what next? To ensure that whatever decisions you made here will be implemented.
The
workshop is more or less a brainstorming session.
Okay.
And what comes out of this workshop will be related to the heads of these agencies.
Okay.
And they will consider it and implement it. And if there's need for them to, take it up to the appropriate quarters, they will do that. But the essence is that there would be an enhancement in government revenue.
After this retreat, what next?
What next? We'll build on this. There are a lot of recommendations that have come out of this retreat. We'll go forward to escalate it to higher levels of authority to make sure that they're delivered.
Okay.
Number one, let me say that we meet every month. Every last Tuesday of every month, we hold meetings, which we rotate among the agencies.
Okay.
Then through that meeting now, we'll be able to see how far each agency has been able even to pursue whatever agreement we reach at this retreat with their various organizations.
Okay.
So with a view to ensuring that whatever we agree are adequately implemented.
Thank you, Christina. Now to the continuation of our interview with Mr. A.J. Bamidele. You said that when you started working with the UN on this, that what your subcommittee drafted cut across countries. It's not just for Nigeria.
It's for developing countries of the world.
Where are the receiving end of the antics of the multinationals?
Multinationals.
Okay,
well,
okay.
There's nothing bad in transfer pricing. It's transfer mispricing that is bad.
What is that?
Okay. Transfer pricing is just an arrangement. I'm your subsidiary, and you are now perhaps selling goods to me. If you sell to me at arm's length, which is the basis of the transfer pricing, you sell to me on arm's length basis. Nothing is bad about that.
You have used another term.
I would say what is meant by arm's length. Now, if you have sold to me on the basis that you can sell to third party, that's what is meant by arm's length. That is
no discrimination.
No discrimination. Good. You said what you can. The way you said to me is the way you will say to another party. In that case, there will be no. There are three parties. The three concepts that we are looking at when you are looking at transfer pricing. The first one is there a related party? 2, is the transaction we are talking about a controlled transaction? And the third one is that does it affect profit or loss? Because profit or loss will affect the bottom line, which is tax.
That's what concerns.
That's the area. But you have to follow it from genesis, from cradle to the time it gets to the grave. And that's the area that we look at. And if this relationship is not there, then the transaction will have been the way you will do it with third party. And then there will be no hidden profit. There will be no shifting of profit from tax jurisdiction to another tax jurisdiction. When you earn income, you will not hide it away because all this you will have known and you will do it in the proper perspective. Can we break this down for the layman? You've spoken about selling to a subsidiary of your company, talking about a multinational now, selling to a subsidiary. If it sells to that subsidiary and it's the same price that you sell it to another party, there's no problem. Does that apply to, let's look at a drinks manufacturing company. We're not allowed to mention names here. Let's look at a company manufacturing stout or fizzy drink. These soft drinks, yes, condensates. Is that involved?
No. A research conducted by one of the bodies on a brewery in Ghana, South Africa, and other countries. And it was also observed that even this money flight, the money flowing out of the country, if you look at it critically, statistics has put it that what the African countries are losing, if you put everything together, transfer pricing issues will account for more than 60%.
Oh my God.
Which means that even the money that, in quote, that you say corruption is taken out of this country and other things that have been done, put all of them together, 60% of them will be traceable to transfer pricing. In that case, should Nigeria sit down and look the apple being taken away? And these are things that put together and say, okay, Nigeria should start looking at this issue of transfer pricing. People have said it's complex. Agreed. It's complex. But it is complex to the extent that between US and UK, there was a company that when they did an adjustment, the company have to pay over $2 billion.
$2 billion, yes. Between two knowledgeable countries.
This is a country, developed countries.
I know.
Talk less of us that we don't.
$2 billion.
We are just coming up.
And they pay.
They pay. Our neighboring country, they are Kenya, is moving very fast and it's reaping so much. South Africa is doing it and getting so much from the transfer pricing. I strongly believe that if we actually have our technical know-how in place, Nigeria will actually move forward.
So when did these regulations take off, or when are they taking off?
Now, the provisions of this regulation, simply put, is this. Signed in August 2nd, 2012. And the provision, regulation says that the effective date of that regulation is the day that it is signed. However, the basis period for which you can start implementing it is accounting period starting from the day it is signed, which means the rendering of returns to FRS will now start after 18 months of signing. Take, for example, companies that have the financial year end 31st December. The effective days of documenting, because what transfer pricing is all about is mostly on documentation. The requirement for documentation will commence from 1st of January 2013. And by the time it's rendering its return in 2018, it will have to submit what we call declaration form and also submit another one, which is disclosure form for transfer pricing purpose.
Okay. And what is the scope? Is it just for multinationals or for oil companies or for what's the scope?
Now, the issue on transfer pricing, in some other tax jurisdictions, there's limited to cross-border transactions. When I say sales, it doesn't really mean sales of goods alone. It goes to rendering of services, secondment of staff, interest on loan, and so many other things are involved. Now, the scope cut across both within and without. That is, it affects the cross-border transaction, and it also affects the transactions within the country. And the comment and questions have been asked why companies within, we realize that companies within the country have been shifting profits. Take, for example, there have been some companies that were enjoying pioneer status, and the day they start enjoying pioneer status, they continue to make profit. The day the pioneer status expire, they convert that company to a branch or a plant, and that plant will start to make loss. Then you start to wonder what happens. But with transfer pricing in place, we will look at is the profit being shifted and how is it being shifted, and treat it as appropriately as possible.
Okay. You also have what we call advanced pricing agreements. You have the provisions for that in the regulations.
Yes.
Who can enter into advanced pricing agreements?
Putting it in a short form, the regulation looks at if you, in any situation, a tax administration will be looking at a way of avoiding dispute. And it is better to avoid dispute than to go into dispute. As such, the regulation recognizes that fact and says, okay, let there be advanced pricing agreement. And for you to enter into this agreement, there are some conditions that are put in place. And few of the conditions are, one, the transaction we are talking, anybody can do it. It's not limited to A, or this company is in this sector, this company is in that sector. But it says that as long as your transaction that is involved are more than 250 million with related party, then you can do it. Then when you are entering into it, you have to give description of the activities, and you have to tell us the methods, because we have about 6 methods you can use. You have to tell us the methods you are using and what is the basis of choosing the method that you are going to use, so that we'll be able to confirm whether it is the best method for that activity or transaction, and so many other things. And either party, when I say party, I mean FRS and our customer, can opt out of this agreement, because there could be conditions that are put in place at the beginning of entering into the agreement, and that condition may not be in existence again. Then the taxpayer may say, because the condition is no longer there, then they are not going into that agreement. Or FRS just observe or note that, oh, this agreement was entered into under a false declaration. In that case, they have void the agreement, and then we get out of the council the agreement. There are other conditions under which such agreement can be cancelled.
Won't that bring a friction?
With,
imagine the FRS just saying, we are opting out of this agreement.
No, when we are opting out of agreement, we write to the taxpayer and give him a notice that this and this are the reasons why we are opting out of this agreement. It will be given out. And when the taxpayer is also opting out of the agreement, he sends a written notice to FRS. And the agreement is meant to last for 3 years. After the 3 years, if you still feel that the conditions that you are under which the agreement was entered into are still in existence, are still remain the same, then you revert back to revenue and say, okay, you still want to keep on to this agreement, let us renew it.
Okay. Now there's another one, safe harbor. We keep having this concept, safe harbor.
Safe harbor is looking at, I talked about dispute resolution. There are organizations, agencies that government have put in place where we have some of these regulations addressing the issue of pricing or setting rates. And those organizations include CBN, Custom, NOTAB, and some other agencies of government. And the regulation recognizes the fact that these are agencies of government. And if they have done something, why do we have to go and reinvent the wheel if it is properly done? The only proviso there is that if it is done, because most of these organizations were set up for other purposes, they were not set up for tax purposes. And what they were doing then were not with the, perhaps they were not bearing tax implication in mind. And bearing in mind that what we are looking at is arm's length transaction. And if the transactions have been done at arm's length and FRS is satisfied that the transaction have been done at arm's length, it is taken and no further documentation will be required. But if it is now found that the transactions were not at arm's length, then it becomes an issue. Because we have prices that have been set in some cases, and even the companies themselves, when they were rendering their returns themselves, show prices that are higher than what the agencies of government have set, which means something is wrong somewhere.
We want to thank you most sincerely for coming on to the program, even as we wish you better luck in collecting more money. It is on that note that we draw the curtains on today's episode of Tax Matters. Next episode, we will serve you the story of the Second International Tax Conference organized by the West African Union of Tax Institutes, WAUTI. It was held in Lagos on the 27th and 28th of March. The second story will be the sensitization workshop organized by the FRS and the Joint Tax Board on developing a presumptive tax regime for Nigeria. Watch out for those stories. We want to thank you most sincerely for watching. From Christina.
Thank you for watching.
And from me, thank you for watching. Stay blessed.